If you're retiring and you want to leave a legacy, you want to give some money to charity, you want to give some money to your kids, wouldn't you rather give more to them than to the government? I mean, if you could give $100,000 to the charity versus only giving $75,000 and paying $25,000 in taxes, wouldn't you want to do that? Well, that's what this video is about. If we haven't met, I'm Eric with Jazz Wealth Managers, where we don't just invest your dough. We like to educate you on your dough. Let's take a look at the handy-dandy board, and I'll show you what I'm talking about here. So I just got off the call with a client, and it was kind of all top of mind, and this is a bit of their scenario. So let's just say that they are around 60 years old, so they're a married couple, and what they want to do is leave some monies to charity at the end, and they also want to leave some money to their children. They want to split it 50-50. Well, a lot of their income is already going to come from Social Security. They're planning to take it at age 62. We've talked about it. We've done some planning. And for their scenario and their goals of building their nest egg, not for themselves, for later in life, but for their legacy planning, that's what they're looking to want to do. So 62 makes sense for them right this second. From there, they've got, let's say, about $400,000 right now that they have. All of it is pre-tax money. We've looked at options like doing Roth conversions and trying to let this grow from a tax-free standpoint, though it doesn't make a lot of sense in their scenario right this second. Not only that, though, what was interesting in this unique situation was that we could actually try to work on doing some tax strategy from the giving standpoint today or in the near future versus trying to wait until later in life. Now, how this is going to work is you've got a couple options here that you can do and a couple things that we talked about. And again, this is unique to their situation, and it will all depend on what tax laws there are. This is always changing, but this is one that, hey, we'll build the plan, and guess what? Things change. That's what we're here for. We want to jump in and help you with the change. So you've got the option of the QCD. So it's a qualified charitable distribution from your IRA account. You can't do that until you're taking RMDs, but at 75 years old, they're going to have to start taking money out of their $400,000 IRA, which hopefully will then have grown to be even more money. Well, you're going to have the RMD that's going to come out. And in this scenario, though, you can actually do $100,000 a year to the charity. The way it works is it's actually going to come right out of the IRA account directly to the charity. Versus if you were to say, well, you know what, I want to take $100,000 out and I want to go ahead and give it to the charity. Well, if you were to do that scenario, what's going to end up happening is if it's all pre-tax money and you say, well, you know what, I've got $400,000 and I'm going to take $100K and now I've got $300 left, but I'm going to give $100. Guess what? That's not the case. Instead, what's going to happen is it's going to show as $100,000 in income. Uncle Sam is going to knock on your door and he's going to say, well, hey, you know what? You're going to owe, let's just, again, hypothetical, but 20% in tax. Well, guess what? Now you're only giving the charity $80,000 and you just gave the government 20%. Aren't they just great with their money? So you've got to think about that way of looking at it. Now, we had another topic that we were talking about with this money, though, as well. And what they could do is if, again, let's just go back to this $400,000. We've got the qualified charitable distribution option, or the other option that we could look at is just taking just the RMD amount. And on the RMD itself, if they don't need that money, they would pay taxes on it. But then what they would do is then they would actually reinvest that money into a taxable brokerage account. The reason for that is because the kids are going to, in this point in time, get a taxable account at their date of death. They're going to get it at a step-up basis. So they're going to get this money at the step-up basis, which means, what does that mean exactly? Well, let's just say the kids inherit $100,000 and there's $50,000 in gains. Well, guess what? They don't have to worry about the $50,000 in gains. They get it for the direct $100,000 that the account is. Well, then from there, if there's any money left in the IRA, if they push as much as they can to the taxable account, have the kids as beneficiaries over here, well, the rest of the money in the IRA goes to charity and taxes never get paid on that either. So it's a cool concept to think through. It's just something to get your wheels spinning a little bit. But if you haven't checked us out, feel free to do that. You can go to jazzwealth.com. We'd be happy to help you as well. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.